I don't like index investing because you're basically saying, I don't know what's going to happen other than I'm going to make a big bet in the US. And to me, that's really cringe because it's like, well, how do you know the US is going to be great? You live here, you're already exposed by that. So you want to make an even bigger bet with your money that the US is going to be the best country. And maybe it is, I don't know. Is there something magic here that doesn't exist in other countries? To some extent, it feels like that sometimes. I don't really care about adjusting free cash flow for stock-based comp. Eventually, these companies don't issue that much stock when you get bigger. If they get reorganized into a bigger company, for example. So I don't think it matters that much. But if there's a huge stock-based comp number, I'm interested in that. But remember, you're also talking about black scholes. So there's other ways to look at how much did that stock-based comp actually affect them and what is it going to do on a going forward basis, which is the more important thing. Of course, Palantir had to give out a lot of stock options, but are they going to have to do that going forward? Probably not. Everybody wants to work there now. I mean, when you invest in emerging markets, you're also making the assumption that equities go up over the long run. And that there's something special about equities as opposed to debt or any other security. And after inflation and taxes, I'm not sure equities and survivorship bias, I'm not sure equities have done that well. So the point is, there's no free lunch, all right? Because if there's a free lunch, we're eating it. You want a free lunch. Just invest in yourself. Try to make money doing some special skill that you're really good at. You're a dentist, be a dentist. Don't try to be George Soros and a dentist. Yeah, Tirana Stock Exchange is long gone. These emerging markets, you basically have to agree to corruption. Some people don't mind. The market's smart. The market's pricing these things in. The market knows that we're not going to destroy capitalism as we know it. Certainly not for most companies. That's why the market's up 42 basis points and not down 40%. If earnings were permanently changed, the market would be down 40%. But we have systems that keep those kinds of things from happening. If presidents make a mistake, we have systems to correct that. If presidents make a good move that people thought was a mistake, which maybe this will be, who knows, then the market will figure that out too. If nobody's sure, well, the market will price in some amount of uncertainty, and we'll go from there. But why in the world would I worry about this? It just doesn't stand to reason. There are people who make money trading the macro environment, but they also never look at stocks. So they trade big baskets of stocks. This is places like Bridgewater, Discovery, Element. There's great Soros. There's great macro investors out there. But they're trading currencies. They're trading bonds. They're trading CDSs. They're trading indices. They're trading interest rates principally. This is not the kind of stuff we trade, and it's not the kind of stuff you can trade. You don't have agreements with Goldman Sachs to trade steepeners and flatteners, do you? So why do you care? I think a lot of people care because they want to maximize their portfolio by timing the market. They're saying, okay, well, maybe the market will go down, so I'll buy then. And do you think the market's going to go down, Martin? I think it might. Well, this is called gambling. And I'm just not going to participate in that because I don't know what's going to happen in the stock market today or tomorrow. And because I don't trade interest rates, I don't trade currencies, I don't trade commodities or indices. I don't want to trade those things. I want to trade stocks. I want to look at one stock and say, well, this is a good stock and buy it. I'll look at another stock, let me short it. And I more or less can try to make money on both directions. And my skill as a stock picker is the thing I'm betting on. I've never met a single person on Wall Street that does all of those things. That looks at every asset class and trades every sector of the world and every asset class of the world. I've never met a single person that can do that. And there's a lot of arrogant people on Wall Street. Nobody is that arrogant to pretend they could do it all, which is surprising because Wall Street's a pretty wild place. Kind of as a value investor is what I care about a little bit. This is more about a method for investing, not about whether I'd be long or short or whatever. This method for investing is, okay, let's say you have a stock, or this is a company, and this is what I'd call the margin of safety. This is not the price. This is different. This is the margin of safety. What is this, anyway? So this, to me, is kind of like the value the permanent value of the company. What does that mean? In pharma, we actually don't get this, which is frustrating. And permanent value is kind of the moat. And this is the earnings that you can kind of rely on for a long time. For Coca-Cola, that's like basically the whole company. But we'll get to that in a second. So this is the stock price. And maybe we're here right now, I don't know. This isn't supposed to be representative of Tesla exactly, obviously. And so the question is, for the black part, you can kind of assume that you're going to be right. You can, I'm sorry, when you're in the black part, you have permanent value that you can sort of sit on and say, I can be long because it's worth, you know, this many times earnings, and it's very stable, and the price supports kind of the value supports the price. When Tesla's all the way up here, you're sort of saying, okay, well, the car business is worth this much, but, you know, the stock's worth a lot more. So either I'm making the wrong assumption about the car business, or there's something else coming, but, you know, this price doesn't really correspond to reality just yet, as far as I can see empirically. And then there's other stocks where what you see is what you get, and that these lines are superimposable in essence. You know, the value of Coke is largely been built up over some, you know, decades, and it's sort of reached an asymptote. And the price of Coke, interestingly, I remember this, believe it or not, kind of overshot this. And Buffett famously said that one of his biggest mistakes was not selling in that period, because this is one of the core dilemmas of and sort of advanced value investing is, if you have a compounding machine, should you ever sell? And Buffett's publicly said no in the past. And I think that the reality is some others have said, and including Buffett, have said yes. There is a price that's too high for everything. Coca-Cola is a wonderful compounding machine on its return on equity and its return on assets and things like that. The so-called Buffett return I've described a few times. You're not getting the price of the original owner. Even if you are the original owner, there is a price that's sort of saying, I'm going to, like this was like 30, 40 times for Coke. And Coke was not growing. It made no sense. This was roughly 2002. And on the assets, like, okay, so this is the Coke plant. This cost, you know, $7 billion in CapEx to create and to maintain. And this was generating $7 billion of cash flow a year. That's 100% return on assets. Well, that's wonderful, but how does that help you as a stockholder? Because the stock's at, you know, 200 billion market cap. Do you really want to pay 200 billion for 7 billion? You know, you cannot increase this return, otherwise they would. And that was the sort of folly of Buffett. And I think he said it was one of his biggest mistakes. Is great, you know, this compounding is fantastic, but I already got the benefits of that. And I cannot compound exactly. I'm only just going to get this 7 billion every year. Now I'm going to get the 7 billion and I could buy back this guy at a certain price. Do I, you know, is this a sale? At $1 trillion, is it a sale? And the previous message was no, at no price could it be a sale. And the new message is, at the right price, it's a sale. There's no business quite like Coca-Cola, it's true. But there is a price that, you know, having a reliable cash flow stream, there are other reliable cash flow streams out there. Maybe you'd argue there's none quite as reliable as Coke, but okay, discount a $7 billion annuity at 1% risk. That's worth 700 billion, right? It's cash flow divided by discount rate. So 2%, you know, it's 50 times, which is 350. And at 3%, you know, you're at 3% discount rate, which you can get from bonds and other things. So is Coca-Cola safe? Sure, but is it safer than a bond? A senior secured bond in the US government? No, it's not as safe as that. So it was overvalued. So this is a philosophical question. Now, getting back to the point of Tesla, there are markets and situations where investors largely, the investors with the marginal capital remaining are only investors who are sort of comfortable living in the black zone. In high risk markets, they're investors with flush with cash that are comfortable living in the orange zone. And that's why they are living in the orange zone. That's why the price of Tesla is 100 plus times earnings, because there are people willing to buy it and sell it at that price. When capital evaporates in a big market crash or a fear or panic, whatever, the only people who have capital, like Paul Singer at Elliott and other value investors like Buffett, they don't buy stocks in the orange zone. They only buy stocks in the black zone. So the prices have to go to the black zone. So this is really, when I describe that tug of war, it's really a philosophical question more than it is like a question with an answer. In essence, you could argue that it's an M1, M2 question, an M3 question. It's a money supply question. Is there money? If people have money, they will do stupid things with it. They will invest. They will speculate. They'll buy IonQ and Rigetti and D-Wave. But they'll also buy good companies like Tesla. Tesla's a great company. Elon's maybe the best entrepreneur ever. And I say that with a huge ego. What you're really asking is, when will the money supply change? Because that's really what matters. And sometimes when you're looking at these stocks, what's more important is, what is their ability to capture people's imaginations? That's why quantum rallied, right? That's why all these quantum stocks are up a lot. They're capturing people's imaginations, and there's tons of cash. Tons of cash. No unemployment, so people had money from that. Rising prices and everything, so people had money from that. I mean, there's not really a whole lot to the strategy other than, I guess I can give you a breakdown of my master plans, okay? Step one, it's a pretty simple plan, but you got to follow it. And you can't omit any of these things, okay? So when I say look at a lot of stocks, I mean hundreds, if not literally every stock in your sector. So like 1A would be, stick to one sector. And, a lot of people think, they have a liberal interpretation of this. This isn't a joke. You got to look at every single stock in your space. There's no ifs, ands, or buts. You can't look at Intel and Taiwan Semi and think you're a semiconductor expert. You got to look at every public company, every private company, every international company. You got to think about starting your own semiconductor company. You got to look at the divisions of in some of the conglomerates that have semiconductor divisions. You got to talk to experts in the area. It's not a joke. I guess number two is, buy the good ones, buy the cheap ones, short the expensive ones, which just goes without saying. And this means ignore the macro, which will save you time. And number two, there's a whole process to that, which is very intensive. But, you got to pick how many companies you want to look at, make it as large as you can possibly do. You got to evaluate the companies, and then you got to execute on the trades. Don't use leverage, but don't be afraid to take a big position on two conditions. One, you're already up. You've booked up a lot of small gains ideally. And two, you do it sparingly. So once or twice a year, maybe 3 times a year, you take a big position. For something like a Cassava or a Galt or Quantum, you don't just take a random huge position every day. I don't look at options flow. It sounds like a waste of time to me, but again, everybody has to do their own thing. Your own strategy is up to you. There's a lot more than this. Like the whole stock evaluation section is obviously something I've taught extensively, but generally you want to ignore a lot of things that make a lot of noise and take up a lot of time, because always go back to number one, a lot of stocks. And this is just obvious why you'd want to look at a lot of stocks, but ignore macro, ignore other traders. This is really big. Other buy side, and ignore the sell side. Do your work all by yourself. I don't even think you should build a big team. I used to think building a big team of analysts was a good idea, but I'm not even sure that's true. Just do it all yourself. That's really it. Everything else kind of falls into place. There's no substitute. If you can't find good stocks to buy and bad stocks to short, it doesn't really matter what stop loss strategy you have. It doesn't matter any of those things. You find a 10 bagger and it's in your portfolio, you're going to make money. It doesn't matter what strategy you have. Low vol, high vol, concentrated, diverse. Not going to make a difference. You're going to make a fortune. Don't follow any buy-siders or sell-siders. You got to do you. They're not putting money in your pocket. You can pay attention a little bit, but at some point, if you just become a hedge fund groupie, that's not going to do you any good. I think you got to have a network. You got to, especially if you want a career, you got to be somewhat personable and talk to the other market participants. And if your strategy relies on market participants, you got to talk to them.
understanding them, what they're thinking. But in general, this strategy is kind of bulletproof for basically just, you could do your own homework and sit in there and study and invest and do anything. I mean, the only thing I'd say about, positioning and trading and stuff like that is, never forget IRR as a concept, a really important concept. A 5% gain in a month is a big gain, and it's a lot better than a 30% gain in a year. And I think one of the faults of the Tiger Cubs was not trading. If you can get a 1% return in one day, that's better than a 5% return in 30 days, and that's better than a 30% return in 365 days. Now, 𝗏𝗏 and 𝗬𝗏 are the stocks that I shorted last year and made a huge gain in. They're dead stocks now. I mean, they're useless, worthless. But you guys saw that adventure was fun. Some of you made some money there. So, while this is true, it is hard to identify. Because this is true, it is quite hard to identify stocks that'll make you 1% in a day or 5% in a month. It's actually very difficult. Because if it was easy to do, you'd have really big returns. So a lot of people gravitate towards this. Let me just figure out what the return is over a year or 2 years or whatever. But the problem is time is your enemy. Time is one thing you can't get more of. And you want to compound quickly. That's why a lot of quant funds focus on this end of the barbell. This end of the barbell is actually quite good because you can make predictions and you can actually still get pretty good returns. So the medium-term investing is quite nice if you can do it. But again, you need a lot of discipline because the IRR is cut against you too. You lose 1% in a day. Well, you keep doing that, pretty quickly you'll be broke. Yeah, slow and steady wins the race, but you should be able to have nice spurts of growth if you do find a cassava, if you do find a galactin every now and then. You have sort of a special project, so to speak, and those spurts will help you, and you get the confidence to take those big chances. If you've been up, you're up 5%, and you say, listen, worst case scenario, I'm dead wrong on this thing, and I'll lose 6-7%, I'll be down 2%. You can survive that. But if you add that 7%, take that big swing, and now you're up 12%, that's a huge gain. Yeah, listen to 𝗓𝗏, he's the man. I owe you a text. Yeah, AVXL could be that this year, INMB. But look, you do have to take risks. I mean, it's not easy to make 30% to 100% a year with 1% positions. That's totally true. But I think when you just start in your account, get your feet wet, get a little bit of profits in the bag, and then start to get a little more confident, get a little bit bigger in some positions. We're big ADMA fans over here, actually, although I'm not 100% sure. And I think it's that first 1% that's hard to make. And you just want to get that. You never want a big drawdown of any huge kind, but you also can't be too afraid to take some risks. And the more profit you've made, the bigger the drawdown you can handle. And listen, day trades can work really, really well because of what I mentioned, that 1% move in one day, or a 1% gain in your portfolio in one day. This happens a lot in biotech where there's some news in biotech and it's being misinterpreted. And you take the other side, you can get 20%, 10, 5, 10, 20% in very quickly. Those will add up.
I've said this a million times. Focus on what you can do. If you want to be a macro person, you can do that. You'll have to find a really good macro person to follow because it's not me. People on Wall Street, you don't do it all. I think the average retail investor doesn't understand that, if you have a job on Wall Street, your job isn't to worry about global trade policy and then also worry about biotech in the same day. It doesn't make any sense. You stick to what you can do effectively and ignore everything else. I would drive myself crazy if I had to worry about the macro environment and how it's going to affect stocks, and then also worry about, if Anavex is going to EMA approval, right? And then also worry about what's happening in crypto or what's happening in real estate or what's what? I know who good macro guys are, but they're not people online you can follow. So I don't know. To me, it's a pretty simple formula that we're doing that I'm trying to teach and have people follow. And you can see that I'm trying to ignore. At the same time, I feel like people are curious. They want to know about it. But I think you have to look at companies. Let's look at PayPal, for example, which we worked on extensively yesterday. We actually didn't really do a DCF, so let me quickly do one. But the point I'm going to make, which I want you to really internalize, is that company is worth the discounted sum of its cash flows. Nothing more, nothing less. Why? Because ultimately, if you're a business owner, if you've ever been a business owner, there's one thing that matters, which is your bottom line at the end of the year. And it's no different with a publicly traded company in the long run. In the short run, there's all kinds of noise and nonsense. I'm trying to encourage you to ignore those things. Why? Because the market is a discounting machine. It is very, very good at also ignoring those things. In relatively short periods of time, the market will see what you see. There'll be noise. The price may not go exactly as you planned. You may get it wrong. But if you follow this method, typically you'll be successful because the market will discount the long-term cash flows of the company into the stock price. The long-term cash flows, here's the real big point I'm trying to make. The long-term cash flows of PayPal have nothing to do with Donald Trump. They really have nothing to do with trade policy. They have nothing to do with anything other than things that affect PayPal specifically. And so to me, and again, I'm not disparaging anybody that looks at the world otherwise, but the way I do things is it would be the very irresponsible and just downright a waste of my time to worry about any of those other things. Because my job is to worry about PayPal. My job is, if I'm trading PayPal, is to learn the payments industry, which quite frankly I don't know that much about. But here's the point. I can take my time, which I have very limited amounts of, and I can invest it in learning a fascinating industry, the payments industry. I learned a little bit about it yesterday. I was reading about Visa, and I could spend a few hours learning about it more today. Or I can worry about what some politicians are doing that I can't change, and that if I hedge appropriately, it doesn't affect me at all. Or at least it affects me very de minimisly. Because for everything I'm long, I have a short, and more or less, it's not going to really impact my portfolio. And the market is smart. The market says, well, even if Trump does this, let's say Trump goes hog wild with tariffs and never stops. Okay, if they're a good move, the new president will keep them. If they're a bad move, the new president will reverse them. And as we discount these cash flows, I really want you to pay attention to this. I've just built a mock sort of DCF. It's pretty elementary, but it'll do for our purposes. And I'm going to bold the net income line, which is the line we really care about as a business owner. And when we buy a stock, you become a business owner. You're a very small business owner, a small fraction of a very large company in this case. But as you become a better investor, you might become a more serious holder of some of the smaller companies. I've certainly owned big chunks of publicly traded companies, so you can do it too. And Warren Buffett, for example, owns big chunks of big companies. But here is the net income. Well, here's the net income theoretically for PayPal. Next year they'll make $6 billion. And the next year they'll make 6.2, and the next year they'll make 6.6, and the next year they'll make 7.1. That's the ideal situation. They may not do that. At maturity, let's assume they'll grow 1%, which is a very modest amount. And I think some of you will give yourself a gold star, and some of you will realize investing is not for you after this question I'm going to give you. So I'm going to discount all of the cash flows by 8%. Okay, and a company goes into perpetuity. It goes out till forever. PayPal may be here 100 years from now. I don't know. But it's telling me that the value of all these cash flows is 121 billion. Now, this is a very dry formula. If you don't know the formula, then I encourage you to learn a little bit of finance, because this is the financial business after all. Okay, so we assume that this is right. This is, when I sum these numbers, they actually sum to a trillion. But because we're discounting them, because the dollars of 2042 are not worth the same as the dollars of 2025, the discounted sum is $121 billion. And that's a lot higher than the current stock price, which is why I like the stock. I didn't even need to do this calculation yesterday. I just knew it intuitively. I wanted to finish the details, but this was more than good enough, just looking at the numbers in my head. But now that they're here, I'm very happy. Now I want to graph this, perhaps graph this, but what I'm going to do is I'm going to copy paste this. Okay, I'm going to copy paste it maybe down here. I'm going to say this is with or without Trump. And let's say Trump makes the earnings for PayPal for the next, when does his term end? 2028, right? He makes earnings for PayPal for the next, is it 26? 28, 28. He cuts them in half the earnings for PayPal. Now, that's not what's going to happen to PayPal, but we're making an extreme example, okay? 50% cut to PayPal's earnings. And the new president changes it back. So if we graphed these two, they would look like this. It's the same line, except the orange line has this like lower earnings, and then they come to the same. When the new president comes and changes things back, perhaps a Democrat, perhaps a Republican, we're back to normal. Now, there is a possibility the new president doesn't change things, but let's exclude that for now. What is the NPV of the bottom line? What is this NPV of this line? Where the next 4 years of earnings are hobbled? Take a guess. I want you guys to think about it. Is it a lot different? It's not a lot different. And that's kind of a worst case scenario, I think.